Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, joined by Dina Ting, Head of Global Index Portfolio Management at Franklin Templeton, JJ Kinahan, CEO of IG North America and President of Tastytrade. We have Joe Cavatoni, Market Strategist in North America at World Gold Council. And finally, Matt Schulz, Chief Credit Analyst of Nasdaq listed LendingTree, to discuss the Fed's strategy on interest rates and inflation and the impact to domestic and global equities, gold, credit, and the consumer. It is great to have all of you with us. Welcome to Trade Talks, and we have a broad topics and a broad, assets classes represented here: equities, gold, and of course the consumer. Credit, consumer is a hot story in the markets. JJ, I want to kick it off with you. Sure. Interest rates, Fed strategy, inflation. How is it impacting the space that you're in with the domestic equities?
Well, I think the biggest thing we're seeing, Jill, is the last 3 weeks we finally saw a little bit of conviction in the market for the first time, in my opinion, in the last 9 months to a year, because I think the Fed, I won't say intervening, it's their job, but the Fed watch, if you will, that we've experienced for the last particularly year, people were a little bit afraid to pull the trigger. One of the reasons, if you look at the mix that's happening of where retail is participating, so many more index products and index-related ETFs as compared to the individual equities. I think it's one of the reasons you saw such a rise in zero DTE options, because people are more confident in a shorter period of time. What they were having trouble having confidence in is, okay, what's going to happen in 3 months? What's going to happen in 6 months as the Fed continued to change things? I actually think the higher for longer is not necessarily a bad thing, because it gives some stability so that people can make some decisions, and I think that's really what's been behind the rally over the last couple of weeks.
Right, and Dina, from a global perspective, how, or what we're doing in the U.S. and other central banks, how is that impacting what you're seeing in the global equity space?
Yeah, so you mentioned about the U.S. interest rate, and what was interesting about international investment is they are impacted also by each of the government policy. Countries such as Brazil, for example, they are already cutting interest rate versus like the U.S., which is kind of a pause. And what that translates into at the end of the day is like the movement in foreign currency among U.S. dollar and the rest. As you know, U.S. dollar has been super strong for many years nowadays, right? But it's probably unlikely to continue. And that's why international market is pretty attractive right now, because you have not only potential for US dollar depreciation, but each of the economy is quite different, right? So if you look at India, where the population now is passing China as the largest in the world, and you look at the growing middle income, and then their aspiration to be a global player, they pass UK in terms of like the ranking and the GDP. And they are becoming a host of G20, right? So they have the aspiration, but they're doing things along the line to be able to grow and be an attractive opportunity for like typical home buyers portfolio, right? Because I think people has been discounting international for some time, but now I think it's a time combination of the different growth, like the growth rate of India is at 7.8%, which is unlike any other places in the world.
Yeah. Well, let's get the perspective from other asset classes outside of equities. Of course, gold being very sensitive to what's happening with interest rates and Fed policy.
This is all really exciting and encouraging to hear from others talking about the fact that there's clarity around the narrative, because that's been the headwind for gold. So as an asset that doesn't pay a dividend or a coupon, it has a comparative against bonds and equities. So the opportunity cost of holding gold while things are in flux has been what's been holding us back on the price directive. So knowing now that we're seeing people getting much cleaner, clearer language around where the Fed's going to go, where the economy is going to go, where rates are going to go, even if it is higher for longer, it's clarity, and that is actually going to be the potential for us to have a breakout in gold. Now, on the flip side, the global nature that you've talked to is critical for us. We've had pockets of growth for gold demand in China through the central bank activity, which I think we'll talk about, but also consumers around the globe are really still fixated on gold and still accumulating gold in large record numbers. Particularly a market like India in third quarter had one of the strongest quarters we've seen in a long time in jewelry. And that's gold in consumer side, pocket money being spent, and actually really exciting to see it. So clearer narrative, actually a lot of activity on the global side, and then all backed up by central bank buying, and that's what's given us our floor. So we're keeping a keen eye on what's going to play out with the Fed, the dollar, rates, but once we have clear narrative, it's going to be an awesome moment for gold.
Right, and perfect segue, speaking of the consumer. Again.
Yes, so in terms of consumer, I think that's a big piece of why international markets is attractive, right? Because you're talking about the size of the demographics that are now starting to spend, whether it's for consumer discretionary as gold, but also like all the financial services that they typically didn't have before. So those are all drivers of why, if you look into the segment, right, not just the large cap, which is more dominated by the global player, but the mid cap piece of it, which has the local flavor, that's like the growth driver that we think is an opportunity in the international market.
Our consumption in jewelry actually drifts from pure consumer jewelry to a form of savings, and it's growing as well into a form of bank account creation, investment creation. And actually, ironically, India and China happen to be the two fastest growing, or the only two markets that are showing strong growth in the ETF market. So you're seeing a small uptick. It's small relative to the overall global size, but an uptick. So people are actually saving, spending, and saving in the form of bank accounts and investments. It's really exciting, but lots of other factors.
And I want to get your perspective, Matt, because clearly you're focused on the consumer, and we have to talk about the debt situation here.
Yeah, and I mean, higher for longer may be great in some ways, but if you're applying for a credit card, if you're buying a car, if you're buying a house, it's not, because especially in credit card space right now, we are seeing credit card rates at levels that used to be reserved for penalty rates for people who were late. So I was looking at store credit cards for a report we're doing at LendingTree, and found that more often than not, these cards now have rates at 29.9 or 30% or higher. There are cards that have 33, 35%. It's a really big deal, and these rates aren't going away anytime soon, and it makes the resilient consumer have to really buckle down, and it makes their situation a lot tougher because most people's financial margin for error isn't that big. And when you have rates this high, it really has a real impact on people's decisions, especially in the holidays.
Yeah.
Well, on that one, Matt, I would say I would agree with you. People tend to find ways to pay for the holidays, so to speak.
Yeah.
And the January could be a punch in the face. But I do think that what we've seen, the price action in crude is helping. And what I mean by that is because obviously that's the first place inflation hits people in the pocketbook.
Sure.
So the fact that we've seen crude come from 85 to mid 70s here over the last few weeks, I think has been good. Now we'll see if we stay there. And the only other thing I was wondering about on the housing, I have a little different theory on the higher for longer because I think that it may normalize prices. I think you have this situation where so many people are like, well, I'm not going to sell yet, or I'm not going to cut my price because if interest rates come down, more people will be able to afford it. So I think a certainty may actually help stabilize, balance, if you will, that market, which is something right now I feel like the housing market's a little bit just out of kilter.
I think that's possible, and I live in Austin, Texas, and our housing market
where it's really out of kilter.
Bananas and just went up like mad, and now it's really gone down quite a bit. And I do think that there would be value in some clarity to that. But if you're talking about the average person trying to buy a house and making that down payment and all, the way that rates have shifted has completely changed the calculus for the house they can buy, not regardless of what the price is, but it's changed where they live in terms of what they can think about housing-wise. So it makes it really tough.
See,
Talking about like the potential overextended of credit of a consumer, if you look at the country, the U.S. GDP, the U.S. debt to GDP ratio, it hasn't been at the level that we're seeing right now, which is 120%. Like in the past, it was always under 50% before we hit all the financial crisis. And so the question is that sustainable, right, at the end of the day? And if you look around, even country that you think is high in debt like Brazil, it's at 80%. And then there are like other countries where more in sub 50 to 40, right? So at some point, looking at the US as the source of your potential return, you need to think through, right? Are we at the brink of default? How far can you extend? Yes, it was the stimulus, but now we no longer have that low interest rate that we were seeing the past 20 years.
Just adding to the comments around the higher for longer, the rate impact on the consumer. At the end of the day, what I think it does is it increases the risks of the risk assets that they're going to behold, the concerns that they're going to have. Again, an environment for us that actually we see the retail flows. Now, I've talked about ETF flows having been outflows. That's more of the institutionally aggregated, retail-minded activity in the ETF market. While it's outflows and it has been down, it still hasn't been big selling. We're still holding at about a $200 billion market worldwide, which is still a very, very large number relative to history. But what we have seen that's actually been very interesting has been consumption in bar and coin, which often gets overlooked because it's a very over-the-counter market. But we've had record quarters, first and third for 2023. We had a record year in 2022. So you see and hear people saying, I'm going to save, I'm going to put money away, and I might be moving away from an asset which might be a bit more risky, might be a bit more volatile, and I'm going to go with a safe haven. So I like the idea of looking at real estate from the perspective of saying, how can I get the exposure to it in a way that I can actually benefit from either price gains and movements that are out there, but move away from it being, an overextension of my own personal financials to get to it, right?
Yeah, and you brought up an interesting point before, JJ, in terms of the consumer and how they might be approaching the housing market and so forth. I wonder if they have, levels have just been reset, right? If you think about inflation, if it's 0% year over year, there's no growth in inflation. Well, it looks very different than it did from 2019. So perhaps consumers they're just releveling what they think in terms of spending. Because I don't see, for example, packaged good companies dialing back on their prices out of their good graces unless the competition decides to do it. I think the consumer just had a re-level set.
Well, I don't think we're done, actually.
Right.
Like I said, the housing to me is the last place where we will reset, because nobody wants to be the first one on their block to cut a price.
Yeah.
And people tend to wait, and then once it happens, it kind of happens all of a sudden, actually. So I do think that's, and again, getting back to the office, et cetera, we had a little conversation earlier, how many days a week are people going to the office and things like that. So I think as companies are like, well, we're based, in New York and you moved to Boise, Idaho, that wasn't our decision. We expect you in the office 3 days a week. So I think you're going to see some resetting in terms of that also. And I just don't know that we've gotten around to that. It seems like the pendulum has started to shift back, and the fact that most companies are now saying you have to be in the office at least some days per week.
On housing, I think keeping a global-minded perspective on things, on housing, you can see it playing out in other markets. For example, in the UK, for example, the rate moves have hit the market. The prices are showing signs of concern. People are actually really feeling it in their day-to-day lives in terms of the housing market. We have that inherent long 30-year fixed mortgage environment. It takes longer to bleed into the system. But you can look around the globe and see rates have moved, people are being impacted, prices are being impacted. It's just going to play out slower for us here in the U.S.
Well, and talking about the return to office thing, that has a huge impact on the consumer as well. And it's not just about gas prices and stuff. It's about extra care for your kid after school. It's about 100 different things. And when you factor in that plus grocery prices rising, all sorts of prices rising, higher interest rates, student loan payments restarting, there's just so many things going on that it makes it kind of hard for the consumer to kind of know what to do. So we're starting to see signs that even though debt is rising as a whole, we're starting to see fewer applications for credit cards. The Fed just came out with some data the other day talking about demand for credit cards and auto loans and stuff being a little lower. So they're spending from what we're seeing, but they're not necessarily going out and acquiring more credit, which is a sign that they may be struggling more than feeling confident.
Right. Well, I mean, I guess it's a good thing that they're not going out to look for more credit, because I think, the error of bailing out everything, it probably won't be an easy pill to swallow in terms of, any other form of stimulus for the consumer.
Yeah, for sure. And what we did see as we all kind of emerged from the darkest days of the pandemic is a huge rush to credit, everybody applying for things and just everybody kind of making up for lost time. And acquisitions were really high, and there's a lot of demand for that. It's not the case anymore.
And if you look at it from a global perspective, what we see in the US is not necessarily the same across the world, right? So if you look at Japan, for example, inflation rate is still quite low. They never reached a double digit. And if you look at the credit, they're still very close to that zero interest rate level, right? So that's why looking at it from a global perspective, this is actually the time to be able to differentiate each of the countries and perhaps look outside US and see like where the pockets of opportunity for potential long-term growth could be.
Yeah, I like that global perspective a lot. It means a lot to us from our asset because our asset is truly global, but also just understanding the potential around how you see the real estate markets or what you can basically see in terms of opportunities or the impact of these markets, I mean, because they're sizable and what they can do for other asset flows.
It's interesting, Matt, when I take what you were just talking about and put it back to how people are actually trading it in the market. It's, our clients, if I look over the last 3 weeks or month, have started to buy Southwest Airlines. Pretty significant stock. But the flip side is they've been selling Carnival Cruise Lines.
Interesting.
So I think it's really interesting that people will still travel, but maybe not travel in the extravagant way, so to speak, they were doing. So let's face it, Southwest is usually a pretty low-cost airline to most places, whereas going on a cruise is a little bit more of an investment. So it's interesting how what you're saying is actually being played out by the investments people are making, and it's really turned over the last 3 weeks.
Yeah, they're taking Southwest to Vegas instead of Delta and American to Paris. Right.
Well, I mean, and that makes you question, how are consumers, how are they allocating their discretionary spend? I feel like once things reopened up, especially in the U.S., you had that revenge travel trade, right? There was also some big ticket purchases that were made during lockdown that aren't necessarily something that you repeat every year. So is it a shift more back to staples and then, determining discretionary spend and that travel trade is over? Then, where's the consumer looking to spend now, I guess is the question, because they've really been, the story to, the most recent bull markets is them supporting the economy. And it's been hard to bet against the consumer.
Well, and it's not only been them supporting the economy in terms of the Magnificent Seven, so to speak, but the other 493 stocks have decided to play for the first time also in the S&P 500. And, in the Nasdaq 100, you're starting to see, again, the secondary level stocks for the first time are being purchased in quite a while.
Yeah. And when our last few minutes here, let's talk about that. When you think about your macro outlook, or you think about your positioning, we haven't even touched on geopolitical tensions, as they've been certainly higher than the last time we all saw each other collectively. How does that impact your outlook? And we'll just go around the table. We'll start with you, Joe.
Look, it's probably one of the biggest factors that we talk to most, whether it's to retail investors or institutional investors, or even when we're dealing with central banks. It's a complicated environment to kind of weigh up how the risk will play out, how long it will play out. We just had a moment with gold in the month of October where we saw a near 8% return on gold because of the conflict with Israel and Hamas. Now, it's a terrible set of circumstances, but it basically reconfirms that safe haven assets have a role to play and they react to geopolitical events. And actually, if you look at the gold performance throughout the course of the year, it's been relatively flat, headwinded by monetary policy, but the return profile has been on the back of a banking issue and now a geopolitical issue in the Middle East. So when we think about it, we make sure that people understand, take a look at a broad-based implication of the geopolitical event. The event that we've just had in October is probably going to be a little stickier because it's going to impact the U.S., which means it could impact monetary, fiscal, political, all these different issues that play out from a U.S. perspective, which is a heavyweight on gold. So we're looking at it in that perspective. We think that the geopolitical events are just going to get more complicated, more difficult to manage, more difficult to understand. On our radar right now is a big challenge around China. How's that gonna, what is the U.S. policy? How is it gonna play out? We're moving into an election year. So lots on the horizon, and our asset tends to perform exceptional in an environment where geopolitical risks play out.
It's also very liquid too.
Yes.
Yeah, so obviously, Joe covered it. It's super complex, only going to get more complex. I think that when you see people unsure, they tend to trade index products. When they get clarity, they trade individual names. It's constantly happens. So again, last couple of weeks saw more individual names. There are two stocks though that are opposite of each other that I find really interesting in terms of this. Number one being people purchasing way more Costco stock. Costco, in fact, has been 75% of the transactions we had were buys, which is pretty high. You know, normally I know that retail has this reputation that if they're only buying, it's usually about a 51-49 or a 52-48 buys to sells. It's actually a very balanced order flow. And on the other side, UPS, which is a name, you know, obviously one I think that we could all say is a great way to maybe measure the economy between UPS and FedEx in terms of shipping. That one, big sell over the last few weeks. Now, the reason I'm drawing out those two parallels, if you think about how Costco makes most of their money, it's still going to that big warehouse. It's not shipping, and et cetera. Whereas UPS, that's one that is used for more global type commerce, et cetera, for the retail consumer. So I think it's really interesting how that's starting to play out. Is this going to be more of a, hey, I want things that I can trust a little more, closer to home, can see and feel, rather than necessarily, so we'll have to continue to watch how that affects the online retailers or even stocks that people may trade here like Baba, et cetera, in terms of what that's going to mean in the U.S. for that.
All right, Dina, Matt.
Yeah, on the geopolitical front, it's a risk that is becoming a bigger factor, and it's definitely something that as an asset allocator, if you want to invest globally, you have to start to quantify that, right? Because geopolitical risk in the past, it was really hard to quantify. But if you are a global investor, you need to start quantifying that. And one way to take a look at that is to kind of like use the macro factors to determine that. But at the end of the day, for our asset classes, which is equity, a single country ETF, which is a very precise and cost-effective tool to be able to get that global exposure, right? If you want to invest in India, it's difficult to get access to be able to invest. But with our single country ETF, you can get exposure to 200 companies really quickly. Same thing with like the valuation everybody has been talking about. But I think what was interesting is the world is changing, and now we finally see less of a correlation, and that's where opportunity will come.
Yeah, and Matt.
Yeah, it's really all about how it'll impact prices, gas, and other things. But it's really, the biggest thing is about the overall economy and jobs, because people are generally doing okay. And the reason why people are still doing okay is the jobs are out there and wages have been rising. If the job market flips, all bets are off. Katie bar the door. Who knows what's going to happen?
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.